Hi, class, and welcome. Welcome all to Chapter 5. Chapter 5, we're getting into fundamental analysis. Fundamental analysis basically is giving us an idea of how healthy a company really is by looking at their financial statements and identifying the ratio analysis also. Those are the two things that will determine whether a company is healthy. Healthy means they're solid, that they're making a profit. Not so healthy means they have more debt than assets and or profit coming in. Let's take a gander. So the concept of financial analysis is the assessment of the firm's past, present, and future financial condition. Condition means healthy. What their behavior has been over the past, let's say, couple of years, maybe even the last quarter. So we're going to find a firm's financial strengths and their weaknesses, which means the debt, to income ratio, to assets, to the liquid, how quickly they can liquidate some of their assets so they can pay some of their bills, and so forth. Some of the primary tools you should be using actually to look at the health or not so healthy companies is their financial statements, comparisons of financial ratios in the past, industry, sector, and other firms, all firms that are related within that industry. So when you're comparing the financial ratios, you're looking from one quarter to another quarter. You want to look at the most current information. You don't want to look 10 years back. You want to look right now because you want to see from this day forward, are they going to be making money? So within the financial statements, we're going to look at their balance sheets. Let's go back for a second. When we look at financial statements, that's the umbrella term for all these other papers and or reports and or disclosures that are under the financial statement. So every company, if they're publicly traded, you should be able to see all of their financial statements. A really good way to go on Yahoo Finance. You see a lot of information there. You can go on Morningstar. Morningstar is a web-based research engine that will show you almost everything you need to know about a publicly traded company. So, going back to the financial statements, we're looking at their balance sheets, income statements, cash flow statements, statement of retained earnings. How much did they actually keep that they earned? Each one of these are going to be a little different. Your balance sheet is going to show you numbers in terms of every asset that they have. Income statement, pretty simple, what's coming in to the company. Cash flow, in and out. Statement of retained earnings, that statement should actually tell you exactly what they are going to be in the black for, what actually they've done to retain themselves and moving forward. So here are the power of ratios. So the objectives of a ratio analysis to standardize financial information for comparison. We want to compare apples and oranges. We want to compare which statements are going to be showing that the company is healthy or the company is not so healthy. Evaluate current operations. What is the company doing? How are they operating? Are they following right now what everyone's doing in 2025 is focusing on AI? Or are they staying in the dark ages and still have things on, let's say, paper, pen and paper kind of a situation? Compare performance with past performance. Are they consistent? Past performance, they were doing spectacularly well. Good example is Tesla. They were doing phenomenally well. They were the company to watch. And then something happened in the last election, and Tesla's CEO decided he wanted to mix up his company with politics, and things went a little different. Every time a company decides to do things politically, you have to focus on the optics. What the world thinks about the view now of that CEO taking, let's say, this new president's side in terms of how to run the United States of America. Compare performance against other firms or industry standards. So other firms, what are they doing? Are they keeping up with, let's say, IBM? If you're starting to invest in Apple, what is Microsoft doing? In other words, whoever is in the same industry, let's see who's outdoing one another. And also industry standards. Are some companies really keeping up with industry standards? Or are they doing a little, let's say, soft shoe tap and getting around some of the standards? Study the efficiency of operations. How efficient? Good example, right now is Amazon, extremely efficient with their operations. They are the company also to set the pace and to set the bar for other companies. And then study the risk of operations. How risky is it? The company you're considering investing in, what are they doing? Are they overseas? Are they here in America? Are they doing things that are cutting edge? Or are they doing things that are very, very, let's say, mediocre? Those are the things you want to look at. The ratio just means you're comparing what they should be doing, what they are doing, and so forth. So ratio analysis. So from the beginning, you're looking at liquidity. How quickly can they take what they have, their assets, maybe their buildings, maybe their equipment, sell it to pay their debts? How quickly can they liquidate? Within a 12-month period also, you want to look at a 12-month period. So say they have debts that they have to pay, can they liquidate items in their company to pay that debt to stay afloat? Investment shareholders, how strong are they in terms of their stocks? Gearing, are they gearing up for the next, let's say, hurdle, the next thing coming up? How about profitability? Are they making a profit? Look at what their sales took in and look at what they made above the sales cost. That determines their profitability. And then also financial. Are they strong financially? That's what the ratio should be telling us. Ratio analysis, liquidity. We just spoke about that. The ability of the firm to pay its way, to pay its debts. Investment shareholders, information to enable decisions to be made on the extent of the risk and the earned potential of a business investment. Gearing, information on the relationship being the exposure of the business to loans as opposed to share capital. That's gearing. Profitability, how effective the firm is at generating profits given sales and or its capital assets. And then finally, financial, the rate at which the company sells its stocks and the efficiency with which it uses its assets. Ratio analysis. So liquidity, you can see basically how solvent is the business. An asset test can be utilized to determine that. Also, look at the current ratio. That's one way that liquidity is determined. And we just covered the other four areas here. The asset test, also known as the quick ratio. Current assets, stock minus stocks, is the liabilities. Seen as an ideal way to determine whether or not the actual current asset is a solid asset. You can see the rest of the information right there. Current ratio looks at the ratio between current assets and current liabilities. Current ratios equal current assets, current liabilities. The ideal is 1 to 5 to 1. A lot of number crunching here, and if you don't understand it, read the rest of the chapter because it breaks it down individually. Investment shareholders. We talked about this. This breaks down what this particular ratio will show as well. Investment shareholders broken down is earnings per share, profit after taxes, the number of shares. Price earning ratio is the market price divided by the earnings per share, and so forth and so on here. A lot of formulas, so to speak, and lots of ways to see how the ratios are going to tell you the health or unhealthiness of the company. We talked about gearing. Gearing, of course, is the financial position, loans over capital, and high gearing loans capital. So you still want to make sure that you're not being held accountable only to the banks. You want to be able to see that it all is an even shake. So gearing ratio, long-term loans, capital employed by 100. The higher the ratio, the more the business is exposed to interest rate fluctuations and to having to pay back interest and loans before being able to reinvest earnings. That's a big factor. When you see a company is gearing, doing a great deal gearing up in terms of taking loans and so forth, they aren't able to really even pay back the stakeholders and stockholders for the folks who actually invested in the company. So watch that ratio closely. Profitability, pretty much common sense on that. Are they making a profit? Financial, we've talked about that. The ratio, what are they doing in terms of making sure that the investors are getting, hopefully, a return for their investment? So the summary of financial ratios goes as such. Ratios help to do what? Evaluate performance of companies. Structure analysis shows the connection between activities and performance. Some of the benchmarks that you should look for is the past for the company. Excuse me. What have they actually done? And the industry. What are people doing globally in terms of that particular industry? Ratios adjust for size differences as well. Now, something also to recognize that we do have some limitations of a ratio analysis. A firm's industry category is often difficult to identify. They might be in a unique niche, something unique that they're doing, so you don't have a comparison of other people, companies within those industries. Published industry average are only guidelines. Accounting practices differ across firms. That's very true. Sometimes difficult to interpret a deviation in ratios. Industry ratios may not be desirable targets. And also, seasonality affects ratios, the season in which the company is performing. So, with that said, folks, that is chapter 5 wrapped up in a nutshell. And I hope that you take a peek at the remainder of the chapter. With that said, I will see you in chapter 6. I'll see you in 2 minutes and 2 seconds.